We just finished going through IonQ's 2026 Q2 earnings call materials, and now we want to share our takeaways with everyone. Here's the question I couldn't put down last night, and I mean that I actually sat with it. How does a company that hasn't cleared $100 million in revenue go out and spend $3 billion buying its own supply chain? Either that's the boldest move anyone in this industry has made, or it's the most expensive way there is to run out of money. That's what we're cracking open today. And I'll tell you straight where I land at the end. The company reported $80.1 million of revenue this quarter, up 287% year over year. That's the fifth consecutive record quarter, and the company states it beat its own internal targets by 20%. Beat your own plan by 20%, 5 quarters running, and I'm telling you that is not luck. Then you look at the other side of the balance, and it's a $1.9 billion GAAP net loss. Company is clear that $1.6 billion of that is a non-cash warrant impact, so it isn't cash walking out the door. Strip that out and adjusted EBITDA lands at negative $120.3 million, which is a number you can actually hold in your hand. But hold it for a second, because $120 million of burn against $80 million of revenue still means spending more than you make. Our take is that the whole quarter is that one balance tilted. Growth on one side and a $3 billion acquisition bill on the other. Which side do you weigh more? Honestly, that depends entirely on whether the money holds out. Most people file this company under quantum computing and stop there, and the material says that's far too narrow. One core technology, trapped ions, and the company maps 5 separate business lines running off it. Quantum computing is the one, system sales plus cloud access, and the company states it's testing a 256 qubit chip right now. The stated goal is scaling to the critical 10 Zalorzen qubit threshold by 2027, and that word critical is doing a lot of work. Then quantum networking for connecting systems together, and quantum sensing, meaning atomic clocks and gravimeters. Quantum security, which is key distribution and defense against future decryption. And the newest one, semiconductor manufacturing through SkyWater. 5 lines off one engine sounds like leverage, and part of me wants to believe that. But a reasonable read is that 5 business lines at this revenue base also means 5 ways to spread yourself thin. I'm maybe 60% on the leverage story, and the other 40% of me has watched small companies do exactly this and lose the plot. Let's do the bridge slowly, because this is where most people either panic or get fooled. Start at the $1.9 billion GAAP net loss, then add back $1.6 billion of non-cash warrant valuation impact. The company states that piece does not reflect operational fundamentals, and on this one, the company has a point. What's left is negative $120.3 million of adjusted EBITDA, and roughly $30 million of that is tied to SkyWater integration and supply chain expansion. So call it about $90 million of ongoing burn and $30 million of building something. And those are 2 different kinds of pain. Now the part I actually liked, remaining performance obligations, the contracted work that hasn't been recognized yet. $122 million a year ago, $470 million last quarter, $485 million now. Think about what that means. They converted a record amount of revenue this quarter and the backlog still went up. To be fair to the bears, backlog is not cash, and a signed obligation is only as good as whoever signed it. But our read is that this is the single most encouraging number in the entire report. Here's the part that actually moves the thesis, and I don't say that lightly. The company splits the machine into 2 separate problems, the shell and the chip. The shell, all the peripherals wrapped around it, was solved years ago, with systems running in market for nearly a decade and on public clouds since 2020. The chip was the missing link, and the company announced that link is now closed. For the first time, they received a fully functional, completely integrated QPU from SkyWater. The company states it combines previously siloed capabilities into one unified architecture. Here's why that matters. The entire bet was moving from scattered optical lasers to semiconductor electronic control. That transition is no longer a promise. It's a physical prototype that works, and the company says so plainly. Think of it like a car assembled from parts pulled off 5 different benches versus one engine block cast whole. Our take is that the technical risk on this specific question just dropped hard, and I put myself at 80% on that. I have a soft spot for companies that put dates on the record, because dates let you grade them later. The company's own timeline starts in September 2025 with the acquisition of Oxford Ionics for electronic qubit control. October 2025, the company claims a 99.99% fidelity world record, with no ground state cooling required. February 2026, 3 distinct tape outs completed for the first semiconductor quantum chip. May 2026, first prototypes mapping to the 256-qubit production spec, and now Q2 2026, the first fully functional integrated QPU in hand. Then the one that counts, H1 next year, commercial delivery and deployment. The company argues the value of this chain is auditability, that a business willing to lock in a hard schedule deserves to be graded against it. I agree with that, and I'd add the other half, because being gradable cuts both ways. Every link in this chain landed roughly on time so far, which is exactly why the next miss, if it comes, is going to hurt so much more. Put the two acquisitions next to each other, and the strategy stops looking like a shopping spree. Oxford Ionics is the design engine, proprietary electronic qubit control that the company says scales on standard silicon. SkyWater is the manufacturing engine, a world-class US-based semiconductor fab. Put them together and you get the closed-loop, fully designed, manufactured, packaged, and deployed on US soil inside trusted facilities. In a world where governments care who touch the chip, that phrase, trusted facilities, is worth real money. Now the bill. The company states SkyWater's $1.8 billion tag was paid largely in stock, and they admit the consequence themselves. Existing shareholders bear the cost of that dilution. To be fair, the company has a point here, because if you're losing money, paying in paper instead of cash is the rational move. But rational for the company and painless for the shareholder are two very different sentences. Our take is that you now own a better business and a smaller slice of it, and you should price both of those honestly. Here's the part I'd argue about at length, and it's the one that made me put the coffee down. The company positions itself as a commercial supplier to the entire quantum industry, not just a competitor inside it. Atomic clocks, sensors, optical subsystems through Nexus Photonics, and 200mm QPU foundry services. And who buys all that? Superconducting players, photonics players, neutral atom players, the exact people trying to beat them. The company frames it as a strategic hedge that no matter which underlying physics wins the race, IonQ collects a toll. I'll be straight with you. I like this, because if you don't know who wins, you sell shovels to everyone digging. But the risk note is printed right there in the open, and I respect that they didn't bury it. To manufacture chips for rivals, IP protection has to be flawless, and the company admits one breach destroys the business line. Our read is that this is genuinely clever and genuinely fragile at the same time. That's not a contradiction, it's just the price of the strategy, and it's a price I'd want management asked about every single quarter. Alright, get a calculator out because this one is pure arithmetic and it's uncomfortable. Q2 came in at $80.1 million, and the company states organic growth ran 132% year over year. Full year guidance sits at $280 to $290 million, so subtract what's already been booked. That leaves an implied second half of $135 to $145 million split across 2 quarters. Do the division yourself, that's an average run rate of $67.5 to $72.5 million per quarter. They just printed 80.1. So the guidance implies the next 2 quarters come in smaller than the one they just celebrated. Sequential contraction right after a record quarter. And that's the whole problem in one line of arithmetic. Now the fair reading, guidance is a floor and not a forecast, and management teams sandbag hardest right after a beat. Our take is that this is either conservatism or a real deceleration, and the material alone cannot tell you which one. I'd say 60-40 it's conservatism, and I say that quietly because I have been wrong on exactly this setup before. So the analysts asked exactly what you just asked, and I want you to hear both sides of this properly. Northland and StoneX put it bluntly that almost any way you allocate the remaining guidance, it implies a sequential revenue decline. The CFO's answer was just as blunt. We are not modeling revenue declines, we are modeling growth. Both of those cannot be true unless something is missing, and the company does name what's missing. A $120 million internal transaction has to be eliminated in consolidation, and it lands exactly across these 2 quarters. The company also states that SkyWater's revenue is currently larger than IonQ's own, which reframes the entire picture. Management's position is that they'd rather wait for finalized consolidated numbers than engineer a Q3 guess that forces a reverse-engineered Q4. To be fair, that is a defensible accounting answer, and I've heard honest finance chiefs give exactly that answer. But here's my read, a defensible answer and a satisfying answer are not the same thing. They've told you the decline is an artifact. They just haven't shown you the arithmetic that proves it. Now the part of the story nobody seems to price, and honestly the part I find most interesting. The company plots 2 curves crossing, with the qubits required to break encryption falling 4 orders of magnitude. Meanwhile, ION's own qubit capacity rises toward 10,000 by 2027, And where those two cross, the company calls Q-Day. And here's the number that stopped me cold. 83 post-quantum cryptography algorithms were submitted to NEST. Roughly 81 of them were proven vulnerable within 90 days, and that ratio is not a rounding error. The software answer to this problem keeps failing, which is the entire argument for a hardware answer. The company's framing is the sharp one. Quantum computing is a future market. Quantum security is a buy it today market. Our read is that this is the most undervalued line in the whole company, and the company itself says as much. Because it converts into revenue now, not in 2027, and I don't see anybody's model carrying it. If I'm being honest with myself, this is the piece that stops me writing the whole story off. 4 cracks and the company grades them itself, so let's walk them in order of how much they'd keep me up. The burn rate is the red one, $417 million of GAAP operating expense against $80.1 million of revenue. That's more than 5 times revenue, and management explicitly stated they will not take their foot off the gas. Second is the post-merger blind spot, and the CFO said it out loud. We haven't looked under the hood of SkyWater for 3 months, it's been days. I'll give them real credit for that honesty, and it still means zero visibility on the consolidated financials. Third, those government agreements everyone got excited about, Andover and Sandia, contribute $0 to the RPO and to 2026 guidance. 0. So, whatever you think they're worth, the company has not booked a single cent of it. Fourth, the gray one. Multi-product sales grew 40% year over year, but management declined to quantify whether integration is driving bigger contracts. Our take is that 3 of these 4 are the ordinary mess of a fresh merger, and the burn rate is the one that's genuinely structural. The company does something here I wish more companies did, putting management's message in the second level read side by side. Management says the semiconductor QPU path is validated and delivery comes in H1 next year. The counter, printed by the company itself, is that moving from prototype to volume production is historically the deadliest phase for hardware companies. That is a business printing the bear case against itself, and pay attention because that is rare. Second, management says $3 billion bought the only fully integrated full stack platform in the industry. The red underneath is that it's a brilliant hedge paid for directly in shareholder dilution, and it demands 0 defect IP protection to hold. Third, management says they're the only long-term defense against Q-Day. Here the second level read actually goes their way, because security revenue converts today, not in 2027, yet management still obscures its exact contribution. Our take is that the pattern across all 3 is identical. The strategy is sound and the disclosure is thin. I can live with an aggressive strategy. Thin disclosure is what makes me shrink the position size. I always read the question count because whatever analysts ask 4 times is whatever they don't believe yet. The tech roadmap and the 256 and 10,000 qubit delivery got asked 4 times, and the company grades management's tone green. Direct, confident reaffirmed the exact timeline. With one exception, the DAPA program stage is bound by a federal gag order. SkyWater integration and financial visibility also asked 4 times, and that one gets graded gray. Confident on the strategy, and then a total blackout on the financial numbers until the integration is fully mapped. Revenue mix and guidance consistency asked 3 times, graded amber, an aggressive denial of any slowdown but evasive on the actual math. Look at the pattern there. Green wherever they can point at hardware, gray and amber everywhere money is involved. Our read is that this is a team genuinely proud of its engineering and genuinely not ready on its accounting. That's a real distinction, and it is not the same thing as hiding something. But you don't get paid for engineering pride. You get paid when it shows up in consolidated numbers. Here's the framing I'd pin above the desk because it reorganizes the entire argument into one line. 3 clocks. The manufacturing clock reads past, the integrated QPU works, and the hardware architecture is physically verified. The delivery clock reads H1 next year, and the company notes the key STI and quantum basal assemblies are already underway. The burn rate clock is spinning fast, with operating expense above 5 times revenue and accelerating. And then the sentence that reorganizes everything. The short thesis is no longer that they can't build it. The short thesis is now strictly a balance sheet question. When can this business feed itself? Sit with that for a second, because the engineering debate is basically settled and what's left is a financing debate. Our take is that this is the most honest moment in the entire report. The company handing you the bear case cleanly. Businesses that hand you the sharpest version of the argument against them usually aren't the ones hiding the ball. Doesn't make the burn any smaller though. It just means you're finally arguing about the right thing. So what do you actually watch? The company ends with a watch list, and for once I'd keep it exactly as written. September 8th, Investor Day, which the company calls the mandatory reveal for combined guidance and the EBITDA reset. That's the date the blackout ends, and everything you currently cannot value finally gets a number attached to it. Q3 earnings, where the question is whether the math actually shows the sequential decline the analysts fear. RPO conversion, meaning the exact quarter the Sandia and Andover agreements move from $0 to booked dollars. Then the hardware markers, CASTI and Quantum Basel final assembly and system turn on and delivery of the 256-qubit system in H1 next year. And the long one, 10 Darwin qubit progress moving from tape out to a validated physical prototype. The company's own closing line is the honest one. That valuation today is incomplete without the SkyWater consolidation. Our take, and I'll be blunt about it, is that anyone building a model on this name before September 8th is building on sand. Wait for the number. That is an indecision. That's refusing to guess when the date is already on the calendar. Alright, last thing, radar always leaves you a light. I'm calling IonQ yellow, and let me tell you exactly why. The engineering question is basically answered. They hold a working integrated GPU, and they have hit every date they put in writing. What stops me is that operating expense runs more than 5 times revenue. The consolidated financials are a blackout. And the guidance math implies a contraction management won't walk you through. That is not a bad business. That is a good business I cannot price yet. Here's what flips it. If the September 8th Investor Day shows a credible path where the burn curve bends while revenue keeps compounding, I go green and I'll say so out loud. If they push the delivery date or the burn accelerates again with still no consolidated numbers, it goes red, and I'd rather tell you that in advance than after. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.